Hey, how you doing? Hoping y'all have a good day today. Slightly disappointed we're still in this hurry up and wait mode. We're gonna come out of it eventually, but today may not be the day. We did give up 60-50. That's a good start, but level by level and 50 by 50 all the way back down. 60, then 59-50, on and on and on. And then cog lines in between all of that as well. Just because. Looking at the options scanner, it's really mostly the same names as usual: NVIDIA, SPY, Tesla, Palantir, but did see some emerging markets. It's a little China, um, RGTI, of course, because they continue to represent the quantum names. Asher is one that we don't see pop in there too much. Intel and SoFi. But oh, and of course, you always got the trash like GameStop. There's always something trash in there somewhere. 90% change on the Palantir calls. Ooh, yeah, that tickles. 258% on RGTI. I bought some calls when I bought shares at around $2.60 on RGTI, and they did okay, but I don't remember it being that good. Whatever. So today we're gonna. You know what? I always felt like I left so much behind on GME. You know, hindsight's always 2020, but I thought we could have done a lot more with it that we didn't do. But you know, it really, I'm surprised we haven't seen more since then that really talks about how much that whole thing changed trading forever. It's I've seen some movies out on it, but nothing as big as we would have expected. Yeah. So we're going to dig into the options risk profile at some point today. And we had a request about market data, L2, and time and sales. And that is always a good topic to go over since no matter what kind of trader you are, you still need to worry about getting filled. And both of those things will help you better understand the price of whatever it is you're trying to trade and perhaps help you get into a trade. Seen we question in the chat about some picks. I think it's the new guy. Probably isn't in the stream. I don't see his name. Yeah, it's quite possible, but anything's good. This is a common request that I see from people that just get into the community, whether they're new or not. Um, on what's a good pick for today? What's a good trade? Give me a trade. Give me. Really, there's always a trade, right? There's a million trades we can pull out at any one time. It always comes down to how much risk are you willing to take? And that's, the defining factor. How much risk are you willing to take? And what is the current risk right now to any trade that you would want to take? How long are you interested in being in the trade? You just want a day trade, something that ends at the end of the week? plan on being in it for a while. How big's the account? You're working with a couple $100, couple thousand. It's such a vague comment that you might as well ask someone, what are you drinking today? Pepsi or Coke? Lemonade? Coffee? It's just so generic. No idea how to answer the question of what's a good trade today. So you can always give a generic answer like probably one that makes you money. You should trade one of those today. Definitely want to get a trade that makes money as opposed to some of the other trades that maybe doesn't make you money. I guess we will start with the L2 and time and sales question. Here is a Thinkorswim chart that I put together. If anybody wants to use that, I'm going to click the link myself and populate. So just open that up. You'll see that it's a chart. I have the ES on it just because that's what I happen to have been looking at. But we want to talk about a more normalized thing like shares and things like that rather than futures. So I'm going to put it on the SPY. We might jump over to the QQQ. Down in the bottom is the L2. Now, all right, so L2. I've never been impressed with L2 because we have the dome, which is this area right here with the kind of black, red, and green. That is the dome. And I find the dome to be so much more useful than L2. But the dome is missing one important part from L2, and that is the exchanges. So if we're looking at blocks or sweeps, blocks can hit mostly a single exchange. Just the idea behind the entire block concept. Whereas a sweep would hit all of the exchanges trying to get something filled. And we can see the exchanges here on the L2. Other than that, all we're seeing there is how many buyers or sellers are sitting at the ask or at the bid. But we can see that oftentimes up at the top. I think I'm not seeing it because the chart is too scrunched up, but generally you'd see it up there. Um, and then you can see it if you just look at the dome. And for me, the dome just makes sense, right? I can see the volume for the day. I can see how many are on the ask or the bid, and it's lined up with price starting at the highs and going down. If you have L2 up and you accidentally sort this in some way, now you've screwed it all up. And I've tried to get it back to normal. Sometimes you can, sometimes you can't. If you start sorting it in some way and you can't get it to go back to normal, remove L2 and then put it back on again. And that will like reset it. So there's the bid, there's the ask or the number of 10 on one and 4 on the other. How would we use this? Well, I'm showing the L2 here, but I'm going to really just minimize that. We're going to go over to the dome. We can use the bid and the ask, the L2, to kind of get a feel for what's over our head and how many market participants we have. If there's uh, a really large position size underneath us or over our head, we can define that as a temporary support or resistance. I don't like using those words in this context. I'd rather use what Jigsaw uses, floors and ceilings. If we have a floor underneath us, that can be eaten out. That liquidity can be removed. And if we have a ceiling overhead, that can be eaten out. That can be removed. So we got price kind of jumping around here a little bit because we are, as soon as I start streaming today, we start rocking and rolling. So we can use this a number of ways. We can gauge how easy it would be to perhaps get filled. Are we trading alone or are we trading with others? I know, right? If my streaming caused this, then I should absolutely be streaming more often. On the dome right now, we can see a lot of participation, but if we go to something a little less liquid, let's just go to something like Caterpillar. you'll see that it's a lot less liquid. There's a lot less participation here. It seems like there's nothing really going on, right? And try to find market participants. If I was trying to get filled here and I wanted to work the order to get the best price, then I've got a better idea of what I'm working with now from this information. So L2 can help you better understand the market participants that are waiting above and below where price currently is and how many people are hitting on the bid or on the ask. It may seem like you're not getting very much for it, but that's because there's really not there for it, right? To clarify for anybody who's really new to trading, L2 is not volume. It isn't a trade. It hasn't happened yet. Time and sales, that has happened. That was a trade that took place. You could consider it volume, but it's a transaction. It's done. It's in the books. So the difference between those two is once it hits the tape, that's something that has actually happened. It is recorded. It can't be taken back. They can close the position, but they can't just remove it. On L2, these positions could disappear at any time. Maybe they play games. We would call that spoofing, where they, put it on, take it off, put it on, take it off, to try to get you to believe that they are trying to build a position somewhere or trying to protect the level when actually they're not. So they can play games, but they're not real positions because they haven't been filled yet. So that's the difference between those two. Now, time and sales in this context with stock actually has more value to you than L2 most of the time. With time and sales, we can look at how fast is it moving. And right now I don't have a filter. This is just raw time and sales. And for me, I don't try to read the raw time and sales. I look at how fast is it moving. If it's moving quickly, you wouldn't be able to read it anyways. It'd just be flashing by there really fast. And the pace of that tape, which is what we're focused on, pace of tape, the pace of that tape would inform you of how aggressive the trading is that's going on right now. Are they hitting it a lot? Are they super excited about it? And then what color do we see in that flashing move? Is it solid red, solid green? That would help us better define one time framing behavior or everybody on the bid, no one on the ask, or vice versa. So when we're looking at time and sales, how fast it's moving and what the color scheme is, whether it's flashing red and green or solid red or solid green, informs you of the market participants' behavior. And then you get those weird things where it just stops moving. That could tell you that you just lost internet. But a lot of times we'll see a pause right before they pile in and change market dynamics. That pause used to really freak me out because one, I would think something's wrong with my internet. But two, it was like, say you're running a machine and you need to recalibrate the machine. First thing you do is shut it off and you change the settings and then you turn it back on again. It really feels a lot like that. Of course, in the modern world, when it comes to algos and everything else, they don't do that, right? But that's what it feels like. So you want to pay particular attention to it if it's been moving reasonably decent and calm and steady and suddenly it just stops. Not for a short period of time like 2 or 3 or 4 seconds, but 10, 12, 15, 20 seconds and it still hasn't moved and then finally it takes off. First time you ever actually see that is probably going to freak you out. So you'll get familiar with the way the tape moves and start to identify these high activity levels and those pause situations. And all of that was from an unfiltered tape. Now we can also begin to filter the tape to help us identify blocks and sweeps. There's big orders that are coming through here, but oftentimes it moves so fast that we can't see those orders. This is really moving slow compared to what I'm used to because this is looking at stock. But if we were looking at futures, it would be moving a lot faster. And so to me, this seems really calm and just relaxed. but still it can move fast enough that you can't read the numbers. So if we're looking for blocks and sweeps with an unfiltered tape, it's going to be difficult. What I recommend is to adjust it for size. Now, we never know what size we need. Every market's going to be different. If we were looking at Caterpillar, a size of 20 would probably be enough, right? We're looking at the Qs. I just put it on 500 and it's still moving as if I hadn't put a filter on it at all. So 500 wasn't enough. We didn't change the pace of this tape. We'll just bump it up a little higher, went to 1K. Now you can see I've adjusted it enough that it's not even off the chart anymore. And it's not moving. So I went too big. If we could find a happy medium somewhere, and we can using a custom size filter, we can put in our own number. We'll try something like 750, try to split the mid, between the 500 we were using and the 1000 here. So yeah, that's a little better. This would help us identify big blocks that come in. Now we can tie that up with what we see down below here if we happen to get a sweep while we're watching both. And maybe it would just be easier if I remove the phase scores here and put L2 down below. That way we've got them both in the same pane. Look at it go, baby. Just keep going. Keep going. So if we're looking for sweeps, we'd want to see that large trade activity matched up with um, preferably something sitting on the level. It's very likely we won't see it if they hit it with a market order, but we can try. And we can verify that looking at how much volume we've had at that level. So we can see 530.50. It's a common options level, a 530 number, 525, 530. All the fives will be an options level, right? And then a round number like 50 quarters work. So 50, 25, 75. We can see this is a large level. It's got a lot of volume here. If we come back near that level, we'd want to see if there's any market participants lining up there again. Same thing down here. That's another really big level in an odd spot at 19, but whatever. Probably some slippage and they ended up there, whether they liked it or not. If we come down into that, we'd want to see if they're what the market participants look like on the bid and the ask as we come down into that level. Now, there's advanced tools when it comes to using L2 and time and sales. There's things like Bookmap or Jigsaw. Um, I've never used Jigsaw for equities. I've only used it for futures, but I know that Bookmap does equities and futures, and it's built into Thinkorswim. So, you know, um, it's it's a limited version. It's not the full version, but if you're just starting out, then it's better than nothing. Right? So you can get started with using a more advanced time and sales and L2 by beginning to use Bookmap. And the free version that you get on Thinkorswim without having to pay anything will offer you alternating markets. So right now they're showing Nvidia and Meta. Every day when you start Bookmap, you never know what you're going to get if you're using the free version. It, the last time I looked, it was Amazon and Microsoft. So there you go, right? They used to show futures here. I don't know if they still do, but for a while it would be one futures and one equity. So I don't know. Maybe now they just only do equity. Use the free one for a while, and if you get the hang of it and you're ready to go for more, then you could get a Bookmap subscription on Thinkorswim, or if you're ready for the big package, then you can just get a Bookmap subscription. Me, I like Jigsaw because I really only use this level of data for the futures, but to each their own. So time and sales and L2 is really going to be useful as a snapshot of what's being traded, how often we're getting blocks and sweeps, how fast the pace of the tape is, and then where are the market participants around the current price action. so that as price drops down into a support level or a potential support level where we expect to see support at like 530, for an example, it's a big round number, options level, we would expect participants to be there. We can watch the L2 and see if they actually are showing up there. Are they putting orders on at 530? Can we see it? Are they pulling and stacking or just stacking and loading? We can prepare for it. That's much better than just assuming that 530 has market participants without ever validating that statement or knowing for sure, right? This is a way that we can validate and know for sure. I am really surprised you weren't able to find something about L2 and time and sales, but I'm glad to have something to talk about anyways. So appreciate the ask. If you guys have topics that you want to hit on, markets that you want to examine, you want to look at charts, talk a trade, really whatever you got, we appreciate the ask. I was going to talk about Goldman Sachs today and a trade that I had highlighted in the chat, and then I realized that it's got earnings within the same window of time as the trade that I want to put on, and so I'm not so interested in putting that on now. The trade was a broken wing butterfly with 630 area as the line in the sand we needed to stay under. And you can see that we ran right up into 630 and we didn't get through there. And now we're back down within the 5-minute open range. Yeah, cumulative delta is another really good one. Put that on the list. If we have time today, we'll get into that one as well. And if not, we'll get into it Friday. So it was kind of a twofold thing. One, I liked Goldman Sachs for this broken wing butterfly under the 630, but it also gave us a way to use the risk profile for the other topic for today, which is using the risk profile to mark up the charts and to have a better idea about the options trade that we want to put on. What kind of risk we have, what kind of reward, what's the probabilities of profit or winning or losing. All of that can be defined from the risk profile. And so if we can better understand the risk profile and how to use it, then we get more out of understanding the risk to our trade. So I was looking at Goldman earlier, and my idea was that we would very likely go ahead and break out of this range, but that the breakout would fail and that we would come back in again. Not long term, because you can see the white line here, the linear regression line. It's continued to point to the upside. And while we have danced above it and below it, we're on our way back up again. So I don't think Goldman's a short in the big picture. I just thought a couple of weeks, a little bit of weakness, we stay under 630 for a little while, we could make a couple $100. So I built the trade, I threw it into the chat. But if we peek at July, you can see that we've got earnings coming up 2 days before the expiration date of that trade. I think it was 2 days before. No, it's the day of. So Goldman Sachs has earnings on July 18th. Our trade was going to expire on July 18th. Not very cool. We can see it's a broken wing butterfly because we have disparate wing size here. It's $5 on one side, it's $10 on the other side. That's why we call it a broken wing butterfly. If you look at it in the Analyze tab, we have this shape. Now, for the moment, I'm going to make one of those lines disappear and really highlight the other line. Can't make it disappear completely, but I'll darken it up enough so it just kind of blends into the background. There we go. So this is the risk of that butterfly that we're looking at down below. The middle of the butterfly is 625, and we can see that it peaks out at 625 here in the middle. And we can see where break even is because this platform highlights it with that little red dash. There's the peak, and this is current price. So as that shifts up and down, you really want to know where that is, because I can't tell you how often I come to the risk profile and then I think, dang it, where's price? Because it's not shown anywhere else on this screen, which sucks, by the way. You would think that they would put that into somewhere on this screen, a little box somewhere, right? Even just a bid ask up at the top, like we have on a regular chart, would be better than nothing. But nope, in their infinite wisdom, they don't show you the price of the market you're looking at. So to see this value, because what happens if you move it, right? Like, uh-oh, now what's the price? I accidentally clicked up here somewhere and now the line's not where it's supposed to be. You can go to, they call it the show actions menu button or the triple burger, call it whatever. I like to just say it's the show actions menu. Go to that and you can tell it to move this price slice, which is what that gold line is. You can set that price slice back to base, to the current market price. So I'm going to tell it base and one standard deviation, which is that weird little A symbol. So when I zoom out a bit, there's the upper edge of the one standard deviation and there's the lower edge. We'll put them together, we have all of this. And it's a little subtle, but there are probability values at the top. If we add those together, it equals our probability range. That's our 68.27% one standard deviation range from high to low. If we had built this butterfly in a different spot, say higher up or lower down, then the probabilities would have shifted to give us a better idea of how likely it is for us to close in the upper portion or the lower portion. These numbers are pretty close together. So at this point, it's like the odds of being in one or the other is 50-50 basically. So we would want to bump the odds up if we needed to be at one side or the other. We'd want to have a better understanding of our probabilities if we were going to do that. So we marked where the real price is. What if we also, or instead, we want to mark where break even is? So maybe we want to look at that on the price chart so that we can have a better idea. What does this trade need? Well, I need price to stay below that break even line, to stay below this. Now I could move my mouse there, try to get it as close as I could, and then go out to the chart, draw a line, and put it in that spot. Could do it that way. Or we can just go to the show actions menu and we can set slices at break even. That's what we want, right? We want to highlight where's the break even in this trade. And it's asking two questions here. Do you want to put the break even at where it would be at expiration? Or do you want to put the break even at where it would be today? We want it at expiration. So I'm going to do that, and it moved the line. Always check that it actually moved the line. I know that might seem silly because it did move it, but this is think or swim. And sometimes you're going to tell it to move the line and it's not going to move the line. So just look and make sure, did it move the line? Yep. We can go back to the show actions and we can tell it what we want to do with that slice. We want to set that slice on the chart. And I don't have to tell it which one because I've only got one showing. But if you had, 32 charts, then choose the chart you want to set it on. So I'm going to set it on one, and there's the line. How do I know that that's the line? Well, one, I cleaned all my drawings off of here before I went over there. But two, if I double click on it, it has the name price slice one. And if I go in here and I tell it to do something else, say if I want price slices at base plus 10%, and I tell it to set those out on the chart, well, now I've got the current market price and those 10% levels, but I don't have that break even one that I had anymore. So if you set a line and then you want to set more lines and keep the original, change the name of the line. I'm going to keep these two on the top. So I'm just going to change the name. You can tell it to show the name if you want. I didn't, but you can, right? Show name. Sure, why not? Show it on the right. So that this way, if I go back in and I put this back on break even and I send break even out to the charts, now I've got my break even and I've still got those old lines that I wanted. It'll use whatever your default drawing is for these lines. So if you don't want to have to go in and change it every time the line gets there, make the line how you want it to be once, save that as your new setting, and then every time you put lines over there, they'll be the right color, line type, they'll have the words or they won't have words, right? They'll be exactly what you want them to be. So from in here, all of these menu choices will do something with those lines, and then you can send those lines out onto your charts. So if you want rows of 2%, they call them steps. From price moving higher and lower, it will lay out 8 rows at each one 2% away from the other one, or 3% away from the other one. And if you want to do dollar values, it'll do that. $2 away, $5 away. This is helpful if you're looking to take profit at percentage levels instead of having to get the calculator out and try to figure out, well, what's 2% away from my entry? Just let this do the work. I mean, I like math, right? So I don't care, but some people get mad just trying to count back change. So, if you struggle with doing the math, let the machine do the work. So, say we want this trade, but we're still unsure of whether or not we want it. We're concerned. So, some of the things that we might want to answer is what's going to happen to my trade if volatility goes up or down? Because we already know what's going to happen if price moves up and down. We can see that, right? As I move my mouse, what I want you to look at is this corner over here. And I say that because right now I'm in drawing mode, so my mouse isn't being registered by Thinkorswim. But when I go back into regular mode, when I'm on the right side of this, I'm in the negative, and when I'm on the left side of this, I'm in the profit area, and my profit and loss will be shown in this lower left corner. So now that I've turned that off, we can see the overshoot into profit is about $225. The max profit is $725, and the max loss is 275. And we can see all of that because of this box in the lower left corner. So we already know what's going to happen if price goes up or price goes down. What I'm interested in, what happens if volatility goes up or down? Is it going to hurt my trade or help my trade? And then as time passes and volatility moves up or down, what's going to happen to my trade? Because the thing about butterflies that's so tricky is you can get to your price target in one day and you still won't have any profit. Like that really sucks. This is a bullseye trade. If you hit bullseye, you would think you should get paid. Unfortunately, you don't just have to hit bullseye, you have to hit it in the right time frame. This trade is for July 18th, and if we get there today or tomorrow, there's no money in this trade. We can highlight that by showing what the current P&L is, which is this yellow line. So at expiration, the trade will resemble this blue or cyan colored line. But for right now, our trade is actually worth the yellow line. And to demonstrate what's going to happen to our trade as time goes by, I'm going to start moving forward in time and watch that yellow line. It's starting to take the shape of the blue line until eventually there's just nothing left because they match each other in time. This is one day before expiration. And you can see that now we're actually starting to get a rise here in that yellow. It's starting to move to the upside. But for most of the time period in this trade, that wasn't true, right? We weren't seeing profit in that level. So we can always ask that question, what's my trade look like a week from now? We can go into the future. Today's the 11th, and we're looking at this trade as if it was the 22nd. We can see it's the, let's go to the 23rd because that's a real market day rather than the weekend. So this is what it would look like. But we didn't move volatility. Generally speaking, if price rises, volatility will stay flat or it will fall. That's generally what would happen. Just remember that this market has earnings in a month. And as we get closer to earnings, volatility is going to rise no matter what the stock price does. But generally speaking, if price rises, volatility would typically fall. But if price falls, volatility should rise. And we're looking to see Goldman fall away from that 630 level. So here we are a couple of days in the future, and we want to bump the volatility up a little bit because price fell down. Now, I only moved it a little bit, and it may not seem like I did much. So to demonstrate how bad volatility could get, let's just get wild with it. This generally would never happen, right? But UNH showed just a few weeks ago, never say never, because we've seen some crazy stuff happen in the UNH, and the volatility was going crazy. So, let's just do it and show what it looks like. So I'm pushing the button and I'm making the volatility more and more and more. And what you may notice is that the gray lines, the gray edges of the box, they're getting wider and wider and wider. We're above 690 and below 560 at this point, and it's still going. It's getting wider and wider. And that's because how far the market could move before expiration has increased because volatility got higher. But our trade didn't swell. It it didn't change the cyan line at all. And that's because this isn't a calendar or a diagonal. We're not moving through two different time frames in the options. So the trade will gain or lose its max profit or its max loss, no matter what the volatility does. It's not going to change that. But what it will do, oftentimes, and it's why we wanted to look, is it'll change the P&L prospectus. This one didn't change, but we didn't know that before we moved it, and it could have changed if volatility was to rise, and that's why we wanted to check what would happen to my trade if volatility does go up as Goldman falls. It's not going to hurt my trade, but it's also not going to help my trade. But at least now we know we were able to check that. That's the whole idea. So we can go into the future and we can run what if scenarios. What if price goes to 650 and volatility falls? What if it goes all the way to 590 and volatility rises? And we can change those settings and see how it looks. And if we like it or we don't like it, whatever. So this is how, when you're going to put on an options trade, you can really start to define, hey, what's my risk? And what do I really need out of this trade? And is there anything that I can do that might remove some of this risk to make this trade better for me? Now, that's a tricky one because, well, better for you may not be better for me. I'm a little bit risk averse. If I can avoid risk, a lot of times I will. So if I can reduce it, I'll take it, even if that means I might have to take a reduced profit. I'm usually okay with that scenario, right? Less risk, less reward. Yeah, okay. I'm game. But other people like to trade different ways. Maybe you like putting on lots of risk because you're interested in lots of reward. There's nothing wrong with it, to each their own. So you can build the trade and ask your what if questions and then try to figure out ways to solve a problem like, oh man, my trade is losing. How can I fix it? Should I roll a contract up or down, close some of the trade, add more to the trade? Once we do that, we can see what the new shape is of the trade to begin to understand how's that going to help. So let's move price. It says that today is the 23rd. So we've been in this trade for over 10 days. And we're going to assume that we were wrong in the trade and that price kept going up and that we're at 635.54. So we're another $5 higher at this, $10 higher at this point. And it shows that right now we are down $18.30. Well, that's not bad. The max is 275, so only being down 18 cents or $18, that's not bad. Well, what if it gets worse? Dun dun dun. That's what we got to fix, right? Or at least that's what we want to know. What can we do? What if we removed some of this risk up here? If the trade's already on, we can't adjust the trade without rolling. We don't necessarily want to make adjustments to the current trade because, well, what if it begins to fall away as soon as we put this trade on? That would that would really suck. But what if we add more instead? We could buy a call. Why not, right? If we think the market's going to continue to run higher, we got $225 when we opened this trade as a credit. We could spend some of that credit. We could buy a call. Of course, the risk is that it already moved 10 more dollars in 10 days and that maybe it's going to stall out here and then we bought a call that is going to lose money, but that would be protection. It would be insurance. We can see what that looks like if we go in and try to buy a call. Ooh, those are expensive calls too. I don't like that idea, but $1,600 we could go in and we could buy a call. If anybody's comfortable with that, knock yourself out. If you just wanted to spend the $200 in credit that we got, you would have to go far out of the money and get something like a $710 strike call. And to be clear, that is really far out of the money. Snowball's chance in hell of ever making you a penny and is most likely just going to be a loss. It's not offering you protection, it's just wasting money. It's going to make you feel good though, because you're going to feel like you're proactive and defending a trade, but you got nothing, right? So buying a call to protect this trade, really bad idea. They're just too expensive. And the one that has liquidity right here, it's not awesome, but it's better than nothing. That's $300. So you'd have to actually pony up more money than you got in credit. Not cool. So what else you got? We could put on something like uh, a put credit spread. And we're going to go out of the money just a little bit. We don't need to get radical with it, but we go $5 wide, go out of the money a little bit, get $2 in credit. And look at that weird shape now, huh? So now our max loss is $80 in this trade, and the max profit is $918. So what did we do here? We reduced our max exposure to the upside. Well, that sounds cool, right? But we also gave away the overhang that we had to the downside. To help you understand what I'm talking about here, this is what we had, right? And here's the zero line. So if we stayed down, no matter how down we went, this thing was going to make money. We didn't have to worry about getting to a perfect bullseye. All we had to do is not go higher than the break even. So stay low, we're good. That was all we needed. But the market didn't stay low. It broke out, ran higher. Now we're trying to solve it. And if we put on this put vertical, we gave away that upside shot. So now we've actually got a downside level that we have to be concerned with and an upside level that we have to be concerned with. Let's put this back on break even because I think it moved, or not break even, the where it thinks base price is 635. So even with what we just built, we're still outside the tent. Well, that's not cool, right? We're still in a losing trade at this point. But we did reduce the max loss from what was it, 250 down to 80. Let's see what that level was. 275. So we took $200 of loss off the table. Hey, that's not bad. So that's what we call defending a trade, right? We can put this vertical on to protect the broken wing butterfly and try to help us out up here. And we reduced our risk. And at any time, we could take that back off and we would be back in this scenario again. And if you think about why we might want to do that, well, if we start to fall and move towards those puts, then we might want to just take them off the board, right? They are 620, 615, so we wouldn't get hit. To be clear, if you can't see it because it's small writing, 620 is way down here and 615 is way down here. We're not worried about hitting the puts. We just don't need them anymore, right? So if the market starts falling this way, as long as we don't break through their break even, that put spread will continue to decay, even if we run at it. And this is what that vertical looks like all by itself. So as long as we don't fall below that level by expiration, we're good. And we can throw that one out on the chart, mark it. At any time, we can close that in profit, and then we would still have this again. As long as we did start to fall, though, right? If we don't start to fall and we hold the line or go higher, then we've reduced everything down to an $80 loss. It's not bad. And we can still try to figure out as we neared expiration what to do with that $80 loss. We could come up with something else, right? Add another put spread. Maybe at that point, we could even think about rolling one of the call legs, turning it into a wider broken wing, or, there's always a choice. And that's the idea of the risk graph, is that you can move things around and ask questions. What if? What if we rolled the 635 out to 640? Right? Like, we never know until we try it. So use the risk graph to really help you with those questions, and use this graph to mark out your charts and where your trade's break even is so that you can visualize, I need price to stay above this level. I need price to stay below that level. To me, it's so much easier to see those lines on the chart and know that, hey, that's my break even line, right? That's the line I need to stay above or stay below because I can see it with my candles. It makes more sense. When I was newer to options trading, I used to draw out on the chart in red boxes and green boxes where my profit and loss was. So, it would look something like this, and I'd have the red on the bottom, green on the top. We'll just make this like a vertical. Little bit of adjustment here. And that way I can better visualize what my trade needs. At expiration, I need to be, above that level, below that level, whatever it needed to be. And those visuals helped me better understand what my trade needed. And at a glance, I could see my trades and see what they needed easily and quickly without having to spend 20 minutes. Because, if it's just one trade, it's not a big deal. But when you're carrying 40, 50, 60 trades and you've had them for weeks and weeks and weeks, you kind of start to forget what each one of them is, and then you got to bring up the chart, study it, figure out what the heck you were doing, what it needs. So take the time to mark out the charts and use the risk graph to help you do it. Then take a picture of it or, annotate it somewhere. I like to use the scratch pad, but to each their own. So this thing will give you probability ranges too. Say you want to do an iron condor. Why not, right? There's plenty of markets right now that really aren't doing all that much. Take a look at something like Visa for an example, just randomly grabbing a name here out of the blue. We'll put it on today's date. There's no reason to get out of line here. And let's just put something in there. It doesn't really matter. Anything. Let's reset it. That'll make it easier. All right, so there's Visa. And we want to know what's the one standard deviation for Visa. And of course, it's going to ask, well, what time frame do you want? Oh, this month's expiration. There we go. That's this month's one standard deviation. If I wanted to build an iron condor, I would want to be outside of those levels. Well, of course, we can take it one step farther from that. What about July expiration? Build the iron condor outside of that level. Now, if you look at the top, it's giving you probabilities here. It's not much, but this one has a 33% chance and this one has 35 and a quarter. So there's a slightly higher probability that we'll close in the upper area of this and a slightly lower probability that we'll close in the lower portion of this. I didn't go hunting for Visa, I just picked that name. But what if we had found something that had a right side tail risk? Right? You're unsure that this is the right side, right? Right side tail risk would be, what if we came in and this side had something like a 45 or a 50% chance, and the other side had something really small, like a 10% chance? That would really stand out, right? It would, hopefully, you would see that and say, oh, dang, look at this. We got some real right side risk here, because it would highlight that. But if you'd never look, if you didn't even know that those numbers were up there, you wouldn't know to look. You wouldn't notice that right side tail risk. So if there is any skew, either left side, right side, if there's any skew, it'll show up here. And those probabilities can give you a little bit of a heads up. Now, this one's janky because we have to keep moving the time. But let's just skip over one to probability analysis. Don't freak out, right? It's the exact same thing that we were looking at, only it's on its side rather than standing up and down, and it curves up at the top. So this one was the same as that one we were just looking at, but it doesn't have the curve here. That's the only difference, right? So the one here, the stock price is at the bottom. The one that we're going to look at, the stock price is on the side, right? But they're the same tool. The difference is what's down at the bottom is time. So now we've got the stock price on the left, time across the bottom, and we can look for probabilities. What's more likely, that we close above, say, 370 or below 370? And by when? Because if we take something like SPY and I ask you, hey, you think we're going to close above 600? One of the first things that would pop into my mind when somebody asks me that question is, by when? Do I think we're going to close above 600 by the end of the day, the end of the week, the end of the month, end of the year? You got to give me something, because just asking me, hey, you think we're going to close above 600? That's not a very good question. It's too vague and open ended. But if I wanted to answer it with time and a true probability, then I could just bring this up. You think we're going to close above 600 by June 27? Right now, there's almost a perfect 50-50 chance. No, I wasn't on the line. There we go. There's almost a 52% chance that we'll close above versus a 48% chance that we close below. Well, that's not bad, but that's right here at the money. What if we skew the odds a little bit? You think we're going to go to 610 by June 27? We got a 36% chance that we'll close up there. You see how that works? Get some probabilities. Is it telling us the future? No, right? It's not predicting that we're going to be up there or not be up there. It's just giving you the odds, the stats, so that you are better informed about the risk you might want to take or not take. This is often a bit too much for people. So if you want it out here instead, I'm going to strip away all the indicators and search for cone of probability. Now, to show you the settings on this thing, we're looking at the next 100 days, and we're using a 1 standard deviation probability, so 68%. And when we put it on, this is what we have. It's that cone that we were looking at, right? But we need more information. These numbers are just floating here in the middle of nowhere. We want to put some time on those. So go to the gear icon, and we want to find the button that says add monthly expiration. I believe is on time axis right there. We can show the year and we can show Friday expiration. That's the one you want. Time axis, Friday expiration. When I do that, we get these red lines, and you'll notice they line up with where those numbers are. So now if I wanted to build an iron condor or a broken wing butterfly, a line to stay above or below, I can attach that to, hey, how far should we move? What's our expected move range for September? 662 to the upside, 550 to the downside. Cool, right? I got more information now. I'm better informed about the position that I might want to take. Well, that's the same thing we were just looking at. It's just a more simplified version of what we were looking at. And you can change the look back period or the look ahead period, and you can change the standard deviation. We've got let's round up and say 70. We've got a 70% chance of staying between those two lines for September. You want to make it 95? Because we can do that. Or 99? Because we can do that, right? 2 standard deviation, 3 standard deviation. How about a 99% chance that we stay inside the lines? We can do that, right? Just change the probability range. If we don't know, if you want the exact probability number, I'm going to put 95 in here because that's what a two standard deviation is. But if you didn't know that and you want to get it perfect, because there's some decimals, we can go back to the risk profile and we can click this, put it on a two standard deviation. It's 95.45. That's the real number. So we'll just put that in there. Maybe it doesn't want that. No decimals? How rude. Yeah, I got decimals. So now it's the two standard deviation. And then, of course, a three standard deviation would be 99. So if we go back to September, we have a 95% chance of staying within those lines at expiration in September. If you're new to options and you think 99% sounds really good, I'm just here to tell you it's not, right? You don't want a 99% chance trade. I know that might be counterintuitive, and you're probably thinking, why would you not want a, a high probability win rate trade, right? Unfortunately, the thing about a high probability win rate trade is the outcome of that 1% of the time when you're wrong, because sooner or later it will happen, right? There will be a loss, and it'll be so radically horrible that you'll wish you never took the trade at all, right? It'll wipe out months of gains, maybe years of gains. So a high win rate probability trade is really just a bad idea. Instead, you want to try to find a sweet spot in those probabilities. Generally speaking, I like 50%. That seems to fit me well. I tend to build my trades near the money. But common market logic people tend to like 75 and 80%. So there's no right way to go or wrong way to go. You just got to kind of find your sweet spot. Now, when we get into probabilities, usually the question is, well, how accurate is that stuff? And, they say that it is statistically accurate over time, but you have to have occurrences, right? If that doesn't make sense, take something that most people are kind of familiar with, like a bowling average. If you only throw the ball once, you don't have an average, right? You just had an incident. But if you throw the ball 75 or 100 times a day and you do that all year, you're going to have a really good idea of what your bowling average is. Same thing with these trades. It might give you a 68% chance, 70% chance, 75, whatever your number is. And if you just put one single trade on, that's not your probability. Your probability in one single trade is about as good as a coin toss, 50-50. Maybe you get it, maybe you don't. But if you did the same trade hundreds of times over the life of the year, you'll stumble into that average that you're looking for. And I think that's what really screws new traders up because they'll hear something like, "Oh yeah, you should do those credit spreads. You know, you'll win 80% of the time." And the first time they try it, they lose. And of course, it's when we first start to wonder, "Hey, what's up? It said 80% chance. How did I lose?" You can skew those odds, by the way, in ways that the options market is blind to. And that works both ways. It might say, sure, that trade has an 80% chance of winning. You should totally try it. And then you get your butt handed to you and you find out, no, you shouldn't have tried that one. That was a really bad idea. Why didn't they see it? Um, Earnings will skew a probability risk reward, right? The market can't see that earnings is coming in that risk graph. So it doesn't know. Drug trials, somebody getting arrested, FOMC, CPI, all of those things, the known and the unknown, can screw with that trade. And so if you're trying to put on an options trade and you're looking at the probabilities and you think that you've got a pretty good idea what your risk and reward are, consider all the information for the life of your trade. That's kind of hard to do when you're looking at leaps. You know, those options that are going to expire a year from now. So many things can go wrong over the next year. How are we supposed to know, right? But that's the kind of things we would need to be concerned with is what if? What if earnings go bad? And of course, we're looking at SPY, so no earnings, but this could be anything, right? What if we get headlines, news, bad drug trial, whatever it happens to be, that we really have to evaluate the life of the trade and what could happen during the life of that trade. So since those probabilities work both ways, you can cheat the system in your favor as well, because this risk graph doesn't know where support and resistance are at, right? It doesn't know where a large volume profile is at, for an example. So we can build butterflies on a high volume node, or we can build verticals against support and resistance, and we'll have a higher probability of success than what is being priced into the options trade. That's one of my favorite things about verticals, by the way. And it's why I like to build them at the money with a 50-50 risk reward. I love it. So let me demonstrate that and why it might suit you to go that route. We're going to build a $1 wide vertical. Let's not use SPY. Um, Microsoft. This thing is a beast right now. Out of all of the Mag 7, this one is the most bullish to me. So we got Microsoft here, $5 wide because we can't get any smaller. $2 in credit. And that's at the money. I'm feeling a little robbed here, but whatever. We'll do it. So there's our $5 wide vertical. We are risking basically 275 for a chance to make 125. I'm rounding there, but you get it. Well, that's not bad. What's my odds of success here? It's about 50%. It's actually a little less than 50%, but it is what it is. Do break even. There's our break even, and there's our probabilities. You can see we're really close to 50%. If we had built that against a major support level, it would be more beneficial to us, right? So let's look at where the last high was, and let's move the vertical to that level. And of course, we don't need this cone anymore. That'll work. The previous high is just above the 10 period daily moving average, and that really lines up to about 465. So if we wanted to build a vertical using that support level, we'd want to be at 465 or below. Well, we built it at 470, 475. So we'll just step down another level here. $1.35. I don't like it, but it's just what we have. Set slices to break even. We've got a 62% chance of closing in the profit zone and a 38% chance of closing in the loss zone. Now, that makes sense that our chances of losing are smaller than our chances of winning because we have more risk than we do reward. That's a fair and balanced options market. That's the way it works. So that was expected. But we don't really have a 62% chance of winning here. We got a higher chance than that because we built this on a support level. Unfortunately, we can't necessarily calculate what our increased probability of success is. There's no way to calculate that. But we know it's greater than what we already had, which is great, right? From that standpoint. So what I try to do, I like to build the spreads that are around 50-50. So this first one, I'd much rather have that one because my risk and reward is more balanced and it's closer to that 50-50 level. And at the same time, if I did that at support, I know it's better than 50-50. So I get the credit of being at a 50-50, but I get the knowledge in my head that, hey, I'm actually sitting on something better than a 50-50. That's what I like to do. If I can't do it, then sure, I'll take this route. It's okay, it's fine, but I like the other way better. And we can visualize what our chances of success are. And it's not perfect, but it helps give us a better understanding of that risk. But here's some of the problems with all of these probabilities. If you look at that run in Microsoft, it's been one hell of a run. That increases the chances that we're going to stall out here and begin to fade. The probabilities are not showing that, right? Because it's blind to that stuff. All this technical analysis that we do, it doesn't see it. Now, tastytrade has argued that the market does see it and that it's priced into those options values. They can't prove it to me, so I'm finding it hard to believe, right? But that's what they say, that it's already priced in there. Maybe it is. Trading is about finding our edge. And so if I can see something that the markets don't see, I tend to jump on it. That's usually why I talk about buying puts when the market is green and buying calls when the market is red. so that I can trade against what the market hasn't seen yet. What I don't like to do is try to jump in with the market when everybody's with the market and we're all going in the same direction at the same time, in options, because your options prices are so badly mangled at that price, at that point, that if the trade loses, it hurts way worse than a normal trade should have lost. So this Microsoft, um, might as well talk about it since Goldman let me down. So with Goldman, it was only a short-term short, so we can't push the time frame out longer unless we actually wanted to go long in Goldman. But with Microsoft, the earnings that are coming up, they're not going to bother us if we want to just continue to go long with a market that is already expected to continue to do well in this long. So if you look at Microsoft right now, and it's a little hard to see because of my indicators, so I'm going to turn them off for a moment. Microsoft has this massive gap, dude. And like, dang, right? That's big. And it actually, the gap is up here and here, because that's a solid blue candle, which means it closed down. And so that is the gap that needs to be closed. 430 to 395. It's $35 gap in Microsoft. It's huge. Put it on a weekly and or maybe a monthly. Where's that gap? There it is. Look at that. That's really unusual for Microsoft, right? Go back and look. Where have you ever seen a gap like that in Microsoft? Ah, Pedro, you got to give yourself more credit than that. So this gap up in Microsoft, in to me, it's really bullish. There's some things that I like. I like a gap on a weekly to the upside. A weekly gap up is amazing. To find a monthly one is really rare, but I'll take it, right? Daily's good, weekly's amazing, monthly's like, I don't know, Butterfinger Twix, right? Like, it doesn't get any better than that. So the fact that it's already run as much as it has does not deter me from this. I still like Microsoft and I like where it's going. I think there's more to offer. I do not think that this is done even a little bit. And I like $500 on this. Now I know it's 470, 500's a long ways off, and we're already in blue skies. I get it, but I still like 500 on this, and it's not going to happen right away. At least I don't think it will, because it's already moved over $100 since earnings. Right, it was down here at like 370, and then it ran up and jumped up, and we're $100 higher already. So I don't think we're going to go to 500, fast, but I'm still long this. I still like this. And while it's uncomfortable to buy something that's already moved this much and is sitting at all time highs, I think it has more to offer. What's unfortunate is it's very expensive, $470 a share. And the options are also very expensive because everybody can look at this and say, wow, look how bullish that was. This is such a huge move. The options are reflecting it. They're very expensive. So if you wanted to participate in Microsoft, it's going to cost you, but not necessarily, right? So I'm thinking at least January. And let's just go back to the charts for a moment so I can articulate this in a way that we can visualize. Clean up the rope a dope here. So I've got weekly on the left, daily on the right, and we're going to start with a simple goal. I think we will close above 470 by the end of the year. Simple enough, right? Short, sweet, to the point. Nothing confusing about that statement. How do we make money on it? So we go in and look at January. If we don't like January's prices, we might go to December's. I caution you against it. December's are filled with short weeks. It's end of the year, so a lot of people aren't showing up. Liquidity really starts to dry up in that time frame. There's just a lot of reasons that if you can do it, just avoid December. Unless you have no intentions of actually holding it into December, then by all means use December if you want to. So I'm going to go to January, and we already got 470 in our heads as the line in the sand that we want to focus on. When we were looking at that broken wing butterfly for a short-term short in Goldman, we were on the call side. Now we're looking at a long-term long in Microsoft. We're going to look at the put side, and we're going to try to price out a broken wing butterfly. So just build a butterfly first and then adjust the settings. So 470 is kind of where we're at already. I'm going to kick off the downside, which I think is going to point us in the direction that we want. Then we'll throw it over to the analyzer and see what we got here. Yeah, that's the direction we wanted to go. So this is risking $320 for an overshoot profit of 180. The max profit is basically 680. And by the way, you're never going to hit max, right? Never, ever, ever. You're not going to hit it. So, you can look at the number just to see what it is, but never plan to hit that. What I like to know that number for is so that I can calculate my probability of profit percentages. I can take 20%, 40%, 60%, but not 100%, right? But I don't like this risk reward shape here. We got a 62% chance of winning. So we got a 38% chance of losing. And it's 320 risk versus 180 reward. And with those probabilities, they say it's fair, it's okay. But I say, I think we can do better. So let's try to do better, right? How can we do better? I think if we move the midpoint up another strike, let's try that. I understand about the internet, man. I feel for you. I live in a small town, and our internet is supposed to be buried cable, and it's supposed to be lightning fast and fantastic. But then we have road workers digging a ditch, ripping up the internet cables out of the ground, and it's just a horrible mess. So yeah, I get it. It happens, but it'll be recorded. and put into the replay so you can catch it there. I'm going to keep this trade because it's already here in case we want to circle back to it. And instead, we're just going to come back over to this spot and just build another one. That way, if we want to jump back and forth between the two trades, we don't have to keep messing with the settings and then accidentally breaking it, right? We just leave that one alone, build another one. I went the wrong dang direction. We wanted more risk, not less risk. Da-da-da. Seen a squirrel. All right, third time's the charm then, I guess. So this is the one with the 75 strike instead of the 70 strike. And now it's 313 versus 187. We didn't get much, huh? Between those three, I thought it'd be better, significantly better, not just a little better. This one's 320 and this one's 313. $7, not much difference here. And you can see it in the price, right? From 180 to 177. We did not gain very much here. Let's push the envelope. And of course, if you don't see the why behind it, it's because the deeper we go into the money on these puts, the more we're messing with that high vol stuff, right? And we're getting into the curve. You see where it goes 23, well, 24, 23, 22, 21, 20, right? We're That's what's messing with us. So let's jump to the other side and use some out of the money calls rather than in the money puts. And we'll just change what leg we adjust, right? I think this will have a better pricing value. Hopefully, I'm not confusing you guys with this one. I have a feeling I moved the wrong side, but let's see. Nope, I moved the right one. 315, 185. The skew ain't helping us out there either. The only difference now is that it's a debit versus a credit, but we have that upside play. And we can keep moving it higher and not have to go deeper in the money like we were on the put side. So let's move this to 85 and this to 80, 70. Wow, after all that, the price didn't change a wink. We're not getting any help in these options out here. They've got everything locked on this thing. It's not moving at all. So at least it's showing up, right? It makes a good example, I guess. If you go in and you try to analyze different trades like this and you're getting barely any change at all, look at how the risk, we've adjusted the risk significantly. It's well over our head now, and the price is still the same. The risk, the reward, it barely changed. And we added all this risk. They should have gave us something. They didn't give us anything. So we don't want more risk in this trade. We want less risk because they're not paying it. They're not paying us to take that risk. So if they're not going to give us that sort of profit, let's remove the risk. And let me explain what we're working with here. So here's Microsoft. We use the daily. What I was doing was building the butterfly at higher and higher levels. And this is a broken wing fly. So instead of being at the money and saying, "Hey, I think we're going to hold above this breakout point," I was saying, "I think we're going to run even higher, get above that level, and then hold above it." And if I'm willing to put on a trade that's accepting more risk, they should have been paying me for it. But what we noticed when I was building all of those is that the risk was increasing, how much we needed out of price to see that trade have any profit at all. That was going up, but the reward for doing all of that hard work was not increasing at all. So we don't want that trade if they're not going to pay us for it. But we can use the insight that we just gained to ask the question another way. What if we do go the other direction and instead of higher, what if we go lower? I accidentally built the one around a 65. So what's that one worth? $1.65 in credit. Our break even is now 458 and it's 335 versus 165. It was 320. Now it's 335. All things considered, we added $13 more risk to the trade, but we lowered our break even significantly in the trade. 458.31. Now we've got them both shown here. That's both of those break evens. And we'll just set them out there on the chart. This way, when we look at it, we can say, hey, for $15 more risk, wouldn't you like to have that lower break even value? So now, instead of a requirement that we need price to close above 463, now we can say we only need price to close above 458. Thinkorswim went a little glitchy there. Let's try that again. All right, break even 3, 468. It's risking 313 to make 187. And it still only requires price to stay above that break even, that breakout point, the previous high. Not perfect on there anyways, but it's close. Let's get that line out of the way. Oh shoot, that's June. We got to get way out here. Hold on. We don't want June. We can go this route. This puts a cap on top of Microsoft. Still collecting a credit, $1.85. So we're risking 315, and it says we don't think Microsoft will get above 500. Now, I'm thinking we're going at least to 500. This would say maybe we got there and we fell back down afterwards, right? Or we never got there at all. So there's that route. If we do it the other way, we're going to create duplicate order. Ah, that's the wrong one. Analyze trade. There we go. So this is just the same thing again, right? But let's back it up to 505 and kick this leg out. Now we're going to pay a debit of 250. We have a profit of 250 basically. So it's a 50-50 chance trade, but it has to have a run up to 500. I mean, I don't know about you guys, but I don't like that trade, right? That sucks. I'm not looking for a 50-50 trade that is 50 points over my head, wherever we are, 25 points over our head. And then we have the tried and true, just a straight up regular everyday butterfly built on the 500. And that's pricing at $50 if we make it as wide as $10. I'm building it on my broker right now. That's why I'm talking a little slow. I'm going to try to fill this for 45 cents. I don't know if I'll get filled or not, but it's worth a shot. Hopefully I don't forget to try to bump the order if I don't get filled, and I'll try again. So I'm trying that. Right, this is the one that I'm going to go ahead and try to take for right now, since the market isn't pricing these others at all in a way that I like. There's a couple of things about this butterfly that is worth considering. Most people who try butterflies haven't really given butterflies a true shot, and they try to trade them short term, right? And the reason for that is because of how tricky it sounds. We have to try to pick where price is going to be at some point in the future, like a bullseye. And that is tricky. So people generally say, well, I'm going to use the shorter duration because I'm more confident in where I think price is going to be in 2 days rather than in 2 months. And I get that feeling. I do. I get it. The problem is with a short duration butterfly is that if you are wrong, your max loss is going to get hit. There's just nothing you can do about it. You really can't fix it. You can either close it or, I mean, really, that's it. You can close it. That's your only choice. You can't really fix it if it's a short term trade. But if it has time to it, like this one, this is a January of 2026, and I'm trying to get filled in it right now in my own account. Not just something to talk about. I'm moving up a penny to 46. If we put this on and a month from now, 2 months from now, it's not really working out, it will have baked or matured, and we've got a much more likely opportunity to roll or adjust or make changes to the trade to defend it because it has life in it. And the reason that that life matters is because of the way it's built. This has two verticals, a call credit spread and a call debit spread. Now, the middle of the fly is at 500. And if we continue to rise up, the debit spread will make money, the credit spread will lose money. But then once we stall and we quit running, if we stay sideways, the credit spread will start to make money and the debit spread will start to lose money. If we never rise at all and we only fall from here, the credit spread will make money. See what I mean? Like, we have time. So I'm going to get this one filled, hopefully less than 50 cents. That's my line in the sand. And we're going to keep it on, evaluate it, adjust it later if needed. And we're going to continue to look for Microsoft to go to 500. Now, over the years, I've had some of these that worked out really good, and I've had some that didn't work out too good. I've never had one of these get a max loss. Not to saying I haven't had a loss, right? They just haven't hit max loss. So if it fills for 50 cents, then our max loss is $50. I mean, I don't want to lose, but $50 ain't going to break me. And I am very confident that I won't lose the full 50. Maybe at worst, I might lose half of that or a little more, maybe 60%, but I'm okay with that risk. What's neat about one of these trades is that a lot of times, if we get a random spike, say FOMC next week, or maybe the next FOMC, not the one coming up, but the next one after that, and we get a big spike, this thing can like get into $100 or $200 of profit for a couple of days before it starts to unravel that again. Because even though it is a time-based trade, if we move towards that area after we've been in the trade for a while, say 5 or 6 weeks, then a solid spike can actually jack those options up for a few days. That happened to me with Amazon and Google last year, having one on this size. The one I had on the video worked good. The one I had on Adobe did not. Adobe, that one hurt. It was like 68, 70% loss on that one. But I was I was wrong on its earnings too, and that didn't help. My track record with earnings is almost flawless because I lose every single one of those earnings trades. Don't do earnings. So this trade has a max profit of 950 and a max loss of 50. And as I mentioned earlier, never expect max profit. But if you can even get, say, 25% of $900, if you think 50% is 450, 25% is $225. You're risking $50 for a chance to make 225. I'm pretty good with that risk, right? And if we look at a couple of metrics, we're aiming for $500 by the end of the year. This says we can actually go $75, which is way more than we need. We only need $25 move. This says we can move $75. Let's look at some open interest and other levels and see if there's anything that could stand in our way. Oh, I got to bump the order. Doo, 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 doo. It's at 48 now. I've bumped the order a couple times. This is what I'm working on, right? That 500, 490, 510. It's that trade. If you're willing to risk more, you could certainly widen the trade out even more. The wider it is, the more likely the trade hits. Um, and if you wanted to stagger or overlap, you could certainly do that too. You know what? Let's check everything into December from July. We'll leave out all this front end stuff. This is open interest for only the puts. We want to do puts and calls. We've got a high concentration, looks like a caller, 440 puts and calls. We can see the calls on the left, 35,700, and the puts on the right, 10,800. So 10 versus 30. What are they doing here? They're selling calls to buy puts, sell three to buy one because their cost is so. No, that's not the 440. No way. No way. Their price is wrong on that, so they wouldn't do that. Let's look at some dealer hedging, the Gex levels, because I think these are dealer positioning. They're just way too deep in the money, right? 440, massive. I'm bringing up the website now, and I got to bump the order. We're probably going to get filled at 50. So since I'm running out of time, I'm moving the price to 50. Well, that still didn't fill. All right, there's Microsoft, and dealer positioning is negative, which means their clients are positive. So the broader market is positive. We want their Gex levels. The 500 puts for January is the most dominant contract today. Imagine that, right? That's exactly what we're looking at. I did not know that this was showing this. Long-term sentiment is bullish. They're all aiming for 500. Yeah. We knew that already. Interest is rising. There we go. 500 open interest, and it's growing. 475 is the area of concern at the moment. 450 is underneath this. we're over the hump already, right? We're at 472. No, we're not over the hump. So these calls are in the way right now. Um, let's check the date. We went July 18, 7/18. Not seeing. Yeah. Yeah. Right. July is not in our way. They're not our problem. Okay. This Friday's calls are in the way, but bigger picture, they're not going to be here. Right. So they'll get out of the way at that point, and then we're good. January 2026, 475 is not a problem. We got 450 underneath us to help us out. 510 isn't even showing, or 500 isn't even showing here. 510 is. Maybe we adjust the butterfly a little bit. Instead of going so cheap, we've got a $75 expected move. Get the open interest out there. The 520 has 6.2 thousand in open interest. Because of that other one that I'm already working, well, no, I guess I can do that. I can be long on there. $47 instead of $50. We really didn't gain much, right? We expanded the distance we need price to move, but we only saved like $4 by doing that. So I don't like that. If we wanted to use the entire range, then we'd be out here to this orange line. So that puts us like right there. And actually, I'm going to go with the open interest on that spot right there. Those 530 calls are not helpful, but you can see the 520s. 520, 540, 550. 7 minutes. Is it 30 or 40? 40. That is what somebody already has built. It's got a heck of a lean to it. Risking 360, max profit 1600, overshoot profit 630. So risking 350 to make 650 ish. I've already bumped it to 50 and it's still not filling. Um, right now its midpoint value is, well, I just seen 35 on there. I'm going to set this at good till canceled, put in 35. It's not going to fill today, but I'm going to continue to try to fill this. The expiration is January, right? It can bake for a couple days as far as I'm concerned. I'm just going to let that one cook. No interest in adjusting that at this point. Now, as for any of these others, this risk reward, I don't like the fact that we have to run all the way up to this level or we're going to risk 300 and something dollars. That's not cool. I'd rather have it the other way around and say that that we're going to stay below a certain level like 600, something crazy like that, or that this risk is less because that's a huge pile to sit on in the hopes that we're actually going to go somewhere before we start to see profit. Now, the thing about that though is if we move fast enough, this isn't going to really reflect that. I don't think. Let's just move price and find out. As we had talked about earlier, we can adjust things, right? So what happens if we get to $500 and we do it by July 18, next month's expiration? This trade would have made $120, right? So you can see, even though it's a kind of a butterfly, it defies the time rule a little bit because of the skewed nature of it, the broken wing part of it. But if we got there like in 3 days, I really don't think it would have much profit to it. So it still needs to bake a little bit. What happens if we get there by the 20th? It actually pays pretty well if we got, oh, we're going by 500. Excuse me. If we got the 500 in a few days, we'd be at 130. Again, not restricted by time like we would expect. So I'm going to try to fill that butterfly today, tomorrow. I don't really care. Probably by the end of the week. I've just got it cooking and we'll see what we get out of it. It's $50, but I adjusted it to 35 and I have it just in there good till canceled. It's whatever at this point. I like Microsoft long. I think it's going to stay above this 470 big picture and that it's going to continue to work towards 500 and then even higher from there. In the shorter duration, there's issues. We got all the tariff talk and all of these hyperscalers continue to just bleed money like crazy on anything AI and quantum, um, the data centers, the SMRs, uranium. There was even news today of another uranium uh, hyperscaler. I'd have to check my notes on it, but Google's got one, Microsoft's got one. I think Meta's about to get one. They're all getting into uranium. So it's going to have issues when it comes to their capex. But this gap is crazy bullish. And it's not normal, right? This is really not normal. And add to it the gap before that. That one, I don't know which one I like more. Probably this one. An earnings gap's an earnings gap, right? We see those all the time in every name because it's earnings. But this gap wasn't earnings. That was the first one. I really like it. And then we had the other one for earnings. So I think there's more to what's coming when it comes to Microsoft. And a monthly gap like that, I looked, I didn't find anything. There's our 500 target, pretty easy. I didn't run to the top, but if you did, 528, you really don't really get much out of that. So if you do want to speculate and use what the market is pricing in on these, there's the one standard deviation that we had talked about. So on the side of your broker, most brokers, it has that. That's your average implied volatility expected move. And in this broker, it's this orange area right here. But if we wanted to use that one standard deviation, the curve that we've been looking at, it's the dotted line here. And a 2 standard deviation is the dotted line here. So one thing that we could do, there's the market, by the way, is you could price in the what if. What if we made a butterfly way out there at the 1 standard deviation level? And I'm actually going to scoot this down a little. I'm not the only one, right? Look at all that open interest there. $100 at a $10 wide, excuse me, a $20 wide butterfly. So we're risking, why is that number so out of whack? It's a $98 butterfly. There shouldn't be that kind of risk there. It should say $99 of risk, right? Not because this isn't skewed. Oh shoot, yes it is. My bad, I missed it. Um, there's not a 590 here. That's why it's skewed. So we have to adjust it. It's 20 points this way and it's 30 points this way. So now it's 30 both ways. It's $122, 30 points. So we're risking $122 for a chance to make $2,800. And it has life, right? It's got all these months, so it can be adjusted, rolled, modified. And if it's losing, we can probably adjust it. I don't see taking the max loss of 122. At worst, maybe we take, 60 or 70%. And that would be like worst case scenario. I might try to fill this one at around $60 first, right? Put it on GTC, good till canceled, throw it out there. It's got plenty of time. The reason I'm willing to give it time is let it bake. It's wide, it's got a lot of time. We got earnings coming up. And who knows, right? It had that really big run up. Maybe it gets a bit of a fade into FOMC or something, and then we feel cheap. I'm willing to try it. It's just shopping around, right? It doesn't hurt anything. Because worst case scenarios, we don't get filled. So what? Right? There's no risk. And if you just want it narrow, like $10 wide, because I got closer, the price went up. It's 207. That 590 is just screwing everything else. $25 for this one. It's $10 wide. or that one. You get the idea, hopefully. Shop around, find something that you're comfortable with in the risk. Use that risk graph to evaluate what can happen if. Plot the lines out on your candle chart so that you can better visualize what the trade needs to be profitable or not. And if you get stuck or have questions, take a picture and put it in the chat. I'm more than willing to talk it out, kind of evaluate what it could possibly provide. One thing I like about Tasty when it comes to these trades is it'll show you in color, right, with the red and the green, and I like that. It makes it a bit easier, right? So pretty easy to see the red there, but you can see how the profit, it's green. You know, I really wish Thinkorswim would update its platform to visualize a trade like that. That would be just fantastic. But whatever. So let's see how Microsoft works. Um, it's not much of a surprise that I'm bullish on it just because of how big of the gap, but it's worth mentioning it already had a really big run. And while this has a lot of momentum behind it, their spending has been extreme. And the market, punishes these hyperscalers when their spending gets out of line. So, we do have to be mindful of that risk. That's what I got for you guys. Unless you got questions, let's wrap it up and get the evening started. I think we're going to have a fire in the yard today and like cook things out on an open flame. That sounds like fun. All right, no questions, huh? All right, everybody, be careful, be safe. I will see you all in the morning at the morning briefing.